Hello, I'm Nick Anderson, board member at the IASB.
And I'm Sid Kumar, member of the technical staff at the IASB.
This webinar covers the new standard for revenues from contracts with customers, IFRS 15, from the perspective of investment professionals. We will highlight the information about a company's revenue that will be provided in the financial statements and notes prepared under IFRS 15. We have developed this content as companies are preparing to publish 2018 annual reports, which will present full-year revenues under IFRS 15, as well as new information resulting from additional disclosure requirements. The key impressions that we hope for you to take away from this webinar are that the principles embedded in IFRS 15 will improve both transparency and discipline in accounting for revenues. I will begin with a brief overview of the standard and some of the changes that investors might expect to see from its application. The remaining items on the agenda will be co-presented by Sid. Throughout the webinar, we'll draw on several case studies to help you navigate through the changes that may result from the application of IFRS 15. In the final segment, I will summarize the discussion together with some key observations. Let's begin with a brief overview of the standard. IFRS 15 came into effect on 1st of January 2018. Apart from early adopters, companies with December 2018 year ends will be the first to present annual results under the new standard. The most significant change that we expect to see from the implementation of IFRS 15 is the application of new disclosure requirements. All companies are required to provide these disclosures, which include information about the breakdown of revenues, contract balances, and the use of judgments and estimates. In addition, for some companies, particularly in sectors like telecom and software, engineering and construction, aerospace and defense, media and pharmaceutical, the timing and amounts of revenues may change under the new standards. We will examine a few examples of these changes in this webinar. Given that IFRS 15 is based on a single comprehensive principles-based framework with more guidance than the previous requirements, it will bring greater discipline in revenue accounting and help comparability across companies. The standard has been jointly developed with the FASB in the US and is fully converged with US GAAP, facilitating improved comparability of revenues on a global basis. When considering the impact of IFRS 15, there are broadly two key aspects that determine the extent of a change for individual companies. Firstly, the starting point, how policies and judgments were applied under the previous requirements, and secondly, the mix of straightforward versus complex contracts within the business. These two factors vary from one company to another, and therefore it's challenging to reach general conclusions about the impact of the new standard. Nevertheless, we will discuss in the next few slides some high-level principles that can guide investors in dealing with any changes. On this slide, we have some of the factors that can be used to identify whether a company's contracts with customers are straightforward or complex in the context of IFRS 15. For example, a contract with multiple deliverables bundled into a single contract is not straightforward. Similarly, if cash is collected at a significantly different time from when the goods or services are provided to the customer, the contract is not straightforward. In such cases, the change to revenues from the application of IFRS 15 will depend on a number of factors, some of which we will discuss in the next few slides. This slide provides a quick summary of how the new requirements work, specifically the five-step approach, which is the foundation of the new revenue recognition model. It consists of 1, identifying the contract with a customer, 2, determining the promises included in the contract. We refer to these promises as performance obligations. 3, determining the contract price. 4, allocating the transaction price to the performance obligations. And finally, recognizing revenue when performance obligations are satisfied. This is when goods or services have been transferred to the customer. The standard includes considerable guidance for each step designed to bring greater transparency and discipline in revenue recognition and measurement. In order to think about how these steps might impact the revenues on adoption of IFRS 15, we need to think about the nature of a company's business model. For instance, companies in the software and telecom sectors often have contracts that contain bundled goods and services. Therefore, step 2, identification of performance obligations or promises in the contract, along with step 4, allocation of the transaction price to the performance obligations, can have an impact on revenues. Step 5, recognizing revenue when performance obligations are satisfied, may result in changes for a number of sectors that have long-term contracts with customers. This is because IFRS 15 includes new guidance on how and when companies recognize revenues over time versus point in time. As mentioned earlier, the biggest change for companies is the new disclosure requirements. IFRS 15 introduces objective-based disclosure requirements for companies to provide investors with information that will help them understand the nature, amount, timing, and uncertainty of revenues and cash from contracts with customers. These requirements are reflected in several disclosures about contracts, which include information about the breakdown of revenues, contract balances, performance obligations, and the use of judgments and estimates, and disclosures related to assets recognized from contract costs. We will examine a number of illustrative disclosures and see how these can be useful in financial analysis. Next, I'll hand over to Sid to elaborate on the identification of performance obligations and related disclosures.
A key step in the revenue accounting model in IFRS 15 is the identification of performance obligations. How a company identifies performance obligations in its contracts has a bearing on the pattern of revenue recognition. We can illustrate this through a simplified example that looks at 3 hypothetical companies, A, B, and C, each in the context of a contract to build a hospital for a customer, which in this case is a government body. In this case, A is a supplier of building materials, B is a construction services provider, and C is an integrated construction company that offers turnkey services. Given the business model for each company, Company A may be contracted by a customer to deliver 5,000 nails and 200 cans of paint. In theory, each nail or can of paint is a separate performance obligation, as the customer can benefit from each unit on its own. Company B may be contracted by a customer to provide construction services to build a hospital while not requiring it to procure materials or providing significant integration services associated with the management of the overall construction of the hospital. In this case, it is the construction service alone that is the performance obligation for Company B. And finally, Company C may be contracted by a customer to build a hospital, which includes providing end-to-end management of the procurement of materials, construction services, engineering, project management, and therefore significant integration services. In this case, delivery of a fully constructed hospital is the performance obligation of Company C. The step to identify performance obligations therefore captures the nature of the business activity of the company and the promise to the customer as a result of that activity. So, how can identifying performance obligations have an impact on revenue accounting on the adoption of IFRS 15? Let's illustrate this using a stylized example of an airplane manufacturer. The manufacturer has to deliver 2 planes of its newly launched model, the Long-Haul 400. The planes are delivered to the customer at the end of the first and second year each. Cash is received on delivery of each plane. The timing of revenue recognition is on delivery, which is the same under the previous treatment as under IFRS 15. Under the previous treatment, there was no specific guidance on how to determine the promises in the contract, and there was no restriction to recognize an average contract margin for each plane that was delivered, essentially treating the delivery of the 2 planes as a single promise of performance obligation. A key change that IFRS 15 will introduce is that the company would account for each plane as a single performance obligation and recognize an individual margin. Let's consider simple numbers behind such a transaction. In this case, we will illustrate that even though revenue amounts don't change under IFRS 15 versus the previous treatment, the margins change on account of the identification of performance obligations. Let's say the contract we are dealing with is to deliver 2 planes for a total price of 150 built at a total cost of 100. A plane is delivered each year for a cash payment of 75. This adds up to an overall contract margin for the 2 planes of 50 over the total revenue of 150, or 33%. We're also told that the first plane is more expensive to build and costs 60, implying that the second plane costs 40. The table on this slide illustrates the P&L and balance sheet under the two treatments. Under the previous treatment, the company accounts for each plane on an average contract margin basis. So in year 1, revenue is 75 and expenses 50, even though the cash cost was 60 to build the first plane, which results in a margin of 33%. This shortfall in expense over cash cost of 10 is reflected in work in progress. The balance sheet has 15 in cash, 10 in work in progress, and 25 in equity at the end of year 1. The same revenue and expenses are recognized in year 2, but with a release of 10 from work in progress, as cash cost of 40 is lower for the second plane versus the expense of 50. The balance sheet at the end of year 2 is 50 cash and 50 equity. Under IFRS 15, assuming the company identifies 2 performance obligations, 1 for each plane, it will no longer be able to apply the contract margin of 33% to each unit, and only unit margin will be reflected upon delivery of each plane. Since the first plane is more expensive to build than the second plane, the company reports lower margins in year 1 and higher margins in year 2. Therefore, in year 1, the company recognizes 75 in revenue, same as under the previous treatment, and an expense of 60, which results in a margin of 20%, whereas in year 2, it recognizes 75 in revenues, 40 in expenses, resulting in a margin of 47%. It is also worth highlighting that none of these costs incurred in the production of plane 1 resulted in the creation of an asset that could then be consumed in the production of plane 2, and therefore none of the costs capitalized on the balance sheet under the new requirements. To summarize, our observations, even though there is no change in revenues in this example, the identification of performance obligations has resulted in the company recognizing individual unit margins instead of contract-wide margins. We have illustrated how the identification of performance obligations is a fundamental step in the model. Let's discuss some of the disclosure requirements in IFRS 15 for this step. For example, companies will have to disclose the nature of goods and services included in the contracts, along with their assessment of the timing of satisfaction of performance obligations, as well as significant payment terms, obligations for returns, refunds, or warranties included in the contracts. Additionally, when companies have longer duration contracts, they may have to disclose the aggregate amount of the transaction price allocated to performance obligations that are unsatisfied. In other words, they may have to disclose information that is similar to order book. Further, they may have to explain when they expect to recognize revenue from these unsatisfied performance obligations. An example of what these disclosures could look like appears on this slide. In this case, the company has presented information about its performance obligations in a tabular format. The company has provided other aspects of the revenue model that relate to performance obligations, such as how it allocates transaction price to performance obligations and when it expects performance obligations to be satisfied. These are examples of the judgments the company would apply to have disclosures in relation to performance obligations. Our next example illustrates disclosure of the aggregate unsatisfied performance obligations, as well as expectations on when these are to be satisfied in the future. The company example on this slide has labeled the aggregate unsatisfied performance obligations as the order book, and IFRS 15 does not restrict companies from doing so. This may not always be the case, and companies may provide order book information which is not prepared in accordance with IFRS 15 separately from the unsatisfied performance obligations disclosure. Therefore, investors should be careful when dealing with different pieces of information. The aggregate unsatisfied performance obligations can offer additional insights into revenue visibility that can be used to build revenue forecasts or scrutinize revenue guidance provided by management. In the next few slides, Nick will use a simple example to demonstrate how revenue under IFRS 15 better portrays the transfer of value for goods and services.
Here, we are looking at an illustrative example showing the application of the new revenue recognition model to a bundled contract comprising a mobile service and handset. This company enters into a contract with the customer to provide a mobile handset at the start of the contract and services over the subsequent 15 months in exchange for a consideration of $60 to be paid monthly. There is no upfront cost or deposit required from the customer for the handset. The total contract value is calculated as 60 times 15, which equals 900. This is known as the transaction price. Two performance obligations have been identified within the contract, one to provide a handset and one to provide service. The company is required to allocate the total transaction price of 900 between the two performance obligations. IFRS 15 provides guidance on how to do this. Our original contract is shown in Table 1. We have also been provided with information in Table 2 that the company uses to determine the allocation to the handset for our original contract. The pro rata allocation to the handset, as seen in Table 2, is based on a standalone handset delivered to the customer for $300, plus a standalone service charge of $60 per month for a 15-month period. This implies an allocation of 25% to the handset. So how does the accounting for this contract under IFRS 15 differ from the previous requirements? Under the previous treatment, the entire amount of 900 is allocated to the services. This is because the company recognizes the equipment revenue to the extent that the amount invoiced and cash received from the customer, which is zero in this case, as there is no upfront deposit. So essentially, something of high value is delivered to the customer, but no corresponding revenue is recognized. Further, since the handset will have been procured at some cost by the telecom operator, it recognizes a loss on the sale of the handset, and it's fair to say that the service payments subsidize this loss on the handset. As a result, we can see that the amount of revenue allocated to services does not faithfully represent the value of that service to the customer. On the other hand, IFRS 15 will result in a more faithful depiction of the contract by allocating the overall contract transaction price of 900 to both parts of the contract, the handset and the service, reflecting their relative values. It will therefore provide greater comparability with companies that held handsets and services separately. Through this approach, 25% of the contract value, or 225, is allocated to the handset. Combined with 540 from services, this results in 765 in revenues in year 1. Year 2 revenue is comprised entirely of service revenue for the remaining 3 months of the contract. We can see that the pattern of revenue recognition and measurement is different under IFRS 15 than the previous treatment. We can see higher revenues in year 1 and lower revenues in year 2 under IFRS 15. Applying IFRS 15 results in a more accurate reflection of the transfer of value to the customer, and a consequence of this approach is an acceleration in revenues relative to the pattern of revenues observed under the previous requirements. Next, Sid will talk about how IFRS 15 helps companies make a fair and transparent assessment of when they recognize revenues.
To share some broader context, analysts may want to analyze the impact of IFRS 15 from 3 perspectives. Firstly, cash receipts are often analyzed alongside accrual revenues, particularly when a cash flow valuation methodology such as a DCF is being used, or a cash flow proxy such as EBITDA is analyzed. In this context, for some companies, revenue may now be closer to cash receipts than before, and examples for this exist in the aerospace and defense sectors, whereas for others, revenue may now be further from cash receipts, and examples for this exist in the telcos. It is important to highlight that IFRS 15 is based on the principle of recognizing revenue to depict the transfer of goods and services for an amount of consideration to which the company expects to be entitled. On the other hand, the timing and amount of cash received in the reporting period may be driven by business practices, competition, and negotiations. Secondly, in terms of timing of revenues, it was also observed that where revenue was recognized over time in the past, for most cases it will continue to be so under IFRS 15. One instance we've seen where this is not the case is some real estate contracts where the contractual characteristics do not meet the requirements in IFRS 15 for overtime revenue recognition. And finally, IFRS 15 provides a lot of guidance on measuring revenues over time, which result in discipline in this area. Often, due to inadequate guidance in the previous requirements, companies would recognize smoothed revenue and margins. Overtime revenue recognition and measurement is often trickier to analyze for investors. This is where IFRS 15 is expected to bring in greater transparency and discipline. IFRS 15 introduces additional guidance for overtime revenue recognition and measurement, which relates to how companies use the input method or input parameters such as costs to measure the progress on contracts. Only costs that contribute to the satisfaction of promises in the contract and result in the transfer of control of goods and services to the customer may be used to measure progress. Costs that are a result of inefficiencies are therefore to be excluded. Similarly, in very specific cases where a company is contracted to source an item from a third party and install the item, and this sourced item represents a major portion of the overall contract value, the input method may need to be adjusted for the cost of the sourced item. Once the item has been procured and transferred to the customer, its revenue should be recognized at cost, and this cost is excluded from the cost measure used in applying the input method. This will result in a more faithful representation of performance in the contract. To see these requirements in action, we have a few examples in the next few slides. This case study examines a company that executes a contract to design and install elevator transit systems. The contract with the customer includes an initial design phase that does not result in any transfer of control of goods and services to the customer, followed by an installation on the customer premises. Let's examine how this contract is treated under the previous requirements. The company recognizes revenue from the time it incurs costs, which is from the start of the project. The amount of revenue is based on the percentage of completion method with the contract cost guidance from IAS 11 construction contracts applied to measure progress. This often resulted in a smoothed margin profile over the contract life. Under IFRS 15, revenue recognition will begin at the start of installation because that's when control is transferred. Let's examine three things that analysts should be mindful of under IFRS 15. Firstly, there may be a delay in revenue recognition to when control is transferred. Secondly, the initial costs up to the point of installation will be stored in inventory at lower of cost or net realizable value. And lastly, revenue measurement is based on the input method, which implies that only costs used to satisfy the promises in the contract may be used to measure the progress on the contract, which is essentially a more disciplined approach to using the percentage of completion approach. This approach may or may not result in smoothed margins. We have another example of a company that executes a business process outsourcing contract. The customer outsources a function, for example, payroll, to the company for a 10-year contract period. This period is comprised of an initial transformation phase, which incurs higher costs, followed by the business as usual phase, which incurs lower costs. Under the previous treatment, the company recognized revenue using the percentage of completion and matched revenues to costs. Since the company incurs higher costs in the initial contract period, which is also the complex transformation phase, the company recognized higher revenues in this period. As a result, we can see that the company earns higher profits in the initial periods, shown in the deep blue columns in the bottom of the chart. Contrasting the previous treatment with IFRS 15, we can see that the company incurs losses in the initial high-cost period, followed by a period of higher profits. Let's examine why the revenue and profit profile looks different under IFRS 15. Firstly, the company continues to recognize revenue over time. In order to measure progress over time, IFRS 15 provides the company with a choice of either using the output it delivers to the customer or using inputs such as costs. The company determines that its performance obligations in such contracts are the restructured and transformed core services, which it specifies as an output that it provides uniformly to the customer over the contract term. And so it measures revenue on a straight line basis using the output method. Secondly, IFRS 15 allows the company to capitalize contract fulfillment costs as these relate to the creation of an asset that will be consumed in future periods when the company provides its services. These could be costs related to the development of processes that the company has had to create internally in the initial period. IFRS 15 requires contract fulfillment costs that have been capitalized to be amortized over an appropriate period, which is shown in the dark aqua-shaded portion spreading over the contract term. Thirdly, we can see that the red line, or cash, is higher in the early periods relative to IFRS 15 revenue, or the green line, and so a contract liability is recognized. Adding all of this up, we can see that the company recognizes losses in early years under IFRS 15 on the contract and higher profits in later years. Now that we've seen two examples that highlight changes resulting from the guidance on overtime revenue recognition and measurement, we can move on to discussing the benefits of the new balance sheet presentation requirements in IFRS 15. IFRS 15 introduces new presentation requirements for the balance sheet items related to revenue recognition and measurement. This relates to the difference between contract assets and receivables. When companies transfer goods and services in advance of receiving cash, either a contract asset or receivable is created. When should a company recognize a contract asset versus a receivable depends on the answer to the question, is the right to cash payment from the transfer of goods and services conditional or unconditional? An unconditional right to payment is one where payments depend only on the passage of time. A simple example of an unconditional right to payment is if a company delivered goods to a customer and gave them 30 days to pay cash. This is a receivable. A conditional right to payment is one where certain conditions need to be met before a company can have an unconditional right to payment. For instance, other performance obligations need to be completed or milestones need to be met. For example, consider a service contract where the overall amount the company will receive over 2 years depends on a performance assessment conducted by the customer every 6 months. If the reporting period or the reporting date is before the assessment date, the company will recognize a contract asset for the amount of revenue recognized. Both contract assets and receivables are subject to impairment testing. This new balance sheet presentation can provide insights into cash conversion and earning quality. For instance, Company A has a rising balance of contract assets and stable balance of receivables. This observation might trigger further investigation into whether the company is having trouble reaching thresholds in its contracts that it needs to achieve in order to have an unconditional right to consideration from the customer. In other words, an analyst may want to further investigate if there is a rising risk of reversal of revenue in the future. Company B, on the other hand, has falling contract asset balances and rising receivable balances. In this case, the company has converted its contract assets to receivables, and the risk now relates entirely to collectibility of those receivables. In this case, analysts may want to further investigate the likelihood of the company collecting on its receivables in the future. Having covered the new presentation of balance sheet items related to revenues, we are now ready to examine disclosure requirements for contract balances. Analysts should note that companies will have to disclose the opening and closing balances of receivables, contract assets, and contract liabilities. They will have to disclose the amount of revenue recognized in the reporting period that relates to the amount included in the opening balance of contract liabilities, as well as disclose revenue recognized from performance obligations satisfied in prior periods. Let's examine some examples of these disclosures. IFRS 15 requires companies to provide an explanation of significant changes to contract assets and liability balances during the reporting period, which must include quantitative and qualitative information. An approach that companies can potentially use is provided on this slide as an example. We can see that $335 million in revenue relates to amounts included in the opening balance of contract liabilities. Contract liabilities are created when cash is received in advance of satisfaction of performance obligations or promises. Similarly, $25 million reflects change to revenues recognized in previous periods from change in estimates. An analyst monitoring these disclosures over time may be able to use this information to judge management's accuracy in estimating revenues. A company that constantly revises revenue from past periods downward may not be using the best judgment in estimating progress on contracts. Another approach companies may use to meet the disclosure requirements is through a reconciliation table for contract assets. The 50 reduction we see in the table reflects the amounts transferred to receivables. Transparency into the movement in contract assets and receivables can help better understand the company's cash conversion cycle. Next, Nick will discuss additional disclosure requirements that are meant to provide investors with further insights.
IFRS 15 has significantly increased the disclosure requirements around the use of judgments and estimates in revenue recognition and measurement. For instance, the judgments made in the determination when control for goods or services is transferred must be disclosed. Similarly, the choice of either input or output parameters used in assessing the progress on contracts must be disclosed. Other areas of judgments, such as the determination of the transaction price and estimating returns and refunds, will also be disclosed. Many of these judgments were made under the previous requirements, but because the disclosures were limited, less useful information was available to investors than under IFRS 15. Another very useful disclosure for investors is the disaggregation of revenues. IFRS 15 requires companies to break down revenues into categories that depicts how revenues are affected by economic factors. For instance, the standard provides examples of categories such as type of goods or service, type of contract, and sales channel. IFRS 15 also requires companies to explain how the breakdown of revenue relates to segment information provided under IFRS 8. This slide presents an example of how additional information about the disaggregation of revenues might be provided by a company. This starts with the status quo, which is IFRS 8 segment information for revenues. Next, we have disaggregation by product type, timing of revenue recognition linked to segment disclosure. In this final segment, we summarize our discussion and highlight the key points related to IFRS 15 for investors. Here we provide a summary of the potential changes to revenue accounting for different sectors. Sector specialists may find it useful to examine any significant changes to revenues resulting from the listed factors. For sectors like consumer products and asset management, the changes may be less significant than for sectors like telco or software. However, across all companies, a careful examination of the new disclosures will be important. Let's summarize the ground that we've covered in this webinar. The new requirements have been developed with the goal of enhancing transparency and discipline in revenue recognition and measurement. That said, their usefulness will depend upon the quality of implementation by companies. Areas that will be useful in the analysis of revenue are disclosures related to the breakdown of revenues, the use of judgments and estimates, and the presentation of balance sheet amounts. We hope that through an improved understanding of the revenue model and the disclosure requirements, investors will be better equipped to have informed discussion with management. We hope you have found this webinar helpful in understanding IFRS 15, its impact on revenue, and the related disclosures. Thank you.